Good afternoon, everyone, and thank you for joining our Q2 Manufacturing Outlook webinar today. I'm Richard Austin, BDO's Head of Manufacturing. For our webinar today, we're delighted to be joined by Make UK's Director of Policy, Verity Davidge, and Senior Economist James Brougham. Verity and James will be providing an update on the state of UK manufacturing and sharing the findings from our latest Make UK and BDO Manufacturing Outlook report. We are also joined by Steve Watts, who's a tax partner at BDO, and Lucy Pringle, Legal Director at Womble Dickinson. With rising intentions, investment intentions across the sector, they will be sharing some very practical insights into navigating the new super-deduction capital allowance, the opportunities it presents to manufacturers, investing in plant and machinery, and the legal contract pitfalls to avoid. The presentations will be followed by a live Q&A, so please submit any questions you have through the Q&A functionality button at the bottom of your screen, and we'll pick these up at the end of the session. Just to let you know, today's webinar is being recorded, and we will follow up with a link to the recording and our Q2 reports. With that, I will hand over to Verity at Make UK. Verity.
Thanks, Richard, and thanks for everyone joining us for today's webinar. I think it's always fair to say that we are continuing to live and indeed work in uncertain and unprecedented times, and I feel unprecedented is a word I have used many times in the last 12 months when we're talking about what's happening during the pandemic. But it's really pleasing to see that this quarter we are painting more of a positive picture from our Outlook findings, and whilst I won't wish to give any spoilers away from James's more detailed presentation, actually to see the headlines of manufacturing bouncing back it seems like a great story to be telling. And whilst, and again, no spoilers, to see what's to come, it may be coming from a lower base. Actually, I think what all of the indicators are telling us now is actually really demonstrating that resilience of the manufacturing sector that we've seen throughout the pandemic, and that we know it will continue to play through the recovery. It's a really interesting week, of course, as yesterday we had the latest update from the Prime Minister, and everyone was eagerly watching to see what was going to happen next. Perhaps unsurprisingly, we've now seen this announcement of the extension of the final stage of lockdown. And I think it's easy to see the impact that this will have on sectors such as hospitality and leisure, but we'll also need to consider the impacts that it will have on manufacturing as well. Even as a sector that has been allowed to remain open and operational during the pandemic, a lot of our quarterly outlooks that you've been hearing about have shown a lack of demand, falls in sales and orders, particularly with certain sectors such as automotive and aerospace. And there are also those manufacturers who are feeding into sectors such as hospitality and leisure. Food and drink equipment manufacturers, for example, will feel the effects of this extended lockdown, and it will be interesting to see in the next quarter outlook how that plays out. But I think even aside from the pandemic, what we're beginning to hear now from companies is other issues almost resurface. So we've spent the last 12 or so months talking about COVID and more recently Brexit. But what I'm beginning to also hear from our members is almost back to those pre-Brexit and COVID issues that were being spoken about. Access to skills, access to finance, support for digital and green adoption, and that's really shining through in the discussions that we're having across our members. I'm really pleased to say that government is very much listening to what Make UK are saying in terms of being that voice of the manufacturing industry, and the work that we do with BDO through this manufacturing outlook is really important because it gives us that insight to be able to influence that agenda. And in particular, where we've seen a lot of interest is around Treasury's announcements for investment. So again, I think it plays into our research around the announcements of the super deduction, which I know is on the agenda for later for a little bit more technical detail. But Make UK's initial research into that showed around a quarter of companies will be increasing investment intentions, and a further quarter we're going to bring them forward. Now, that could lead to a spike in investment and then perhaps a tailing off at the end, or it could just start to be that nudge factor for manufacturers to invest further and then look outside of the super deduction to the extended increase in annual investment allowances and actually see more progression to adopting both green and digital technologies. I mentioned that we're beginning to see the issue of skills resurface again. And one of the things that we have found, obviously, through this latest manufacturing outlook is employment intentions beginning to increase. And that's a huge positive, particularly as we've been reporting quite large-scale redundancies throughout the pandemic through our sector. So if I think about this time last year, we were probably reporting redundancies around half of our members, with some of them making up to a quarter of their workforce redundant. So fast forward 6 months and we seem to be, in a slightly then better place, employment intentions beginning to pick up. Of course, the challenge next for companies will be being able to find those people with the right skill set. And some of the feedback I've definitely been picking up recently is companies not just reporting that they can't access the skills domestically, but they're seeing a number of their employees, particularly from the EU, actually return to the EU and not come back to work with them. And that builds in another bigger challenge and leads to a more tightening of the labour market. So I think one of the interesting trends that we will definitely be tracking as well is perhaps what happens to pay. So with the tightening of the labour market, will we begin to see pay again in our sector increase? I heard a couple of companies reporting at our regional advisory board meetings recently that they were paying a premium of around 15 to 20% in order to be retaining highly skilled engineers. So it will be interesting to see how that plays out across the wider sector. Of course, companies could then look to recruit from outside of the UK. However, what I think they'll be surprised to see is this new immigration system that they probably haven't been engaging with since the start of the year, because those employment intentions perhaps haven't been there. But for a lot of Make UK members in the wider manufacturing industry, actually recruiting someone from outside the UK will be more costly and more complex, and they may have to engage in a process that they haven't done before. So that will bring us back to that whole discussion internally on the, what can we get from the domestic labour market? And I'm anticipating a lot of questions and queries and kind of pushes to government around policies involving apprenticeships and technical education. And I'll be back to where I was 5 years ago, we're talking about the apprenticeship levy all over again. So I think that there's really interesting results that we are seeing from this outlook that James will go into detail. And I think that we are in a very positive place now, and it's great to be telling that more positive story of manufacturing bouncing back. But of course, with that will undoubtedly become challenges itself as companies look to grow, look to access finance, look to access skills, and look to adopt new technology in order to recover. So on that note, I will pause and I will hand it over to James.
Thank you very much, Verity. Well, good afternoon, everyone. I'm James Brougham, Senior Economist at Make UK, and I'm going to take you through our this quarter's quite interesting findings in Manufacturing Outlook. Those of you that have joined us in previous quarters have probably heard us tell quite a negative story. At least the data has been quite negative, unsurprisingly, over the past 4 quarters. And now, quite refreshing, what I'm going to bring you is real sort of hope and positivity. What the figures are posting this quarter. We started to see a little bit of that coming through as green shoots last quarter, but this quarter we can be quite confident that we're certainly on that road to recovery within the sector. So what I'll do, I'll take you over a brief overview, and then we'll go into some depth on some of the key metrics before wrapping up. So the headline point is in Manufacturing Outlook's 30-year research history or so, and about 24 years of consistent data metrics, we posted the highest ever quarterly output balance figure. However, this is coming from a very low base, and these are quarterly change figures, but nonetheless, it is still the highest in our entire history. But it's also worth mentioning that in this second quarter last year was the lowest ever, most negative output balance figure that we'd ever recorded. So quite a sudden effect, and we'll see that in some charts in a moment. Critically, export orders have turned to a positive balance figure. And now last quarter, when I was talking about those green shoots, export orders was that one metric that still was negative, and actually got even more so negative than it was in Q4. This was largely due to the infamous effects of the TCA at the very start of the year. Prices are rising both in the UK, at both domestic and export prices, but margins remain in negativity. This is the only metric that's not on a ship going upwards, and that's something that's needs to be paid attention to. And I suppose in terms of negative aspects of these figures that I'm presenting you today, that's something to look at, and we'll go into that in a moment. Employment and investment both come out of negativity from last quarter, although they had been trending up for 2 quarters, but they're now in firmly positive territory, both for different reasons, but still a very good signal for the sector. And most importantly is that to indicate this is not a blip, expectations for the following quarter for manufacturers themselves are even more optimistic, despite this quarter posting some highest ever figures, and we may very well be able to say the same again in Q3 this year. As a result of all this positivity and boosting confidence, the manufacturing forecast for 2021 has been significantly upgraded. It sat around in Q1 at about 2.6%. It's now 7.8% for 2021, which interestingly actually outpaces our UK economy-wide forecast at 7.5%. And that's quite an unusual phenomenon in these quarterly manufacturing outlook forecasts, to see the manufacturing forecast outpace that of the wider economy. And that's a result of the real confidence and surge of growth that we're recording in our figures. So now we'll go into some of the metrics in depth. So if I could have the next slide, please. So this is that output that I was talking about, and the highest ever in manufacturing outlook's history. And if we look on the far right there, we see that balance figure of 36. But as I also mentioned, Q2 last year, you see that extreme depth of minus 56. We've come a long way quite quickly. As you see, it's minus 56, minus 36, minus 5, then 936. And obviously, these figures represent a quarterly balance of change. So it's not to be underinterpreted as 36% improvement in output, more so 36% of companies which have taken part in the research on balance are experiencing growth in those orders. So it's good for looking at trends in between quarters in a microeconomic fashion. Can I have the next slide, please? And export orders, as I was mentioning. Now, if we look quite carefully on the right, the third set of bars from the right, we'll see that actually that orange bar went more negative in Q1 than it did in Q4. And this was a result of the difficulties manufacturers faced immediately in the immediate term after the start of the year in exporting to the EU, and partners and customers in the EU taking more time to process that. And that really hampered that Q1 performance. Very quickly now in Q2, it was surprisingly so, the pace at which this has occurred. We see that orange bar now on the penultimate set of bars there, jumping up into significant positivity. But even more interestingly, that next 3 months bar on the far right, which is where we ask manufacturers themselves, what's your view of your business's performance, let's say within export orders in the next 3 months? It's even more positive, both on UK orders and export orders. And that's really fueling that narrative below the surface, that positivity and hope for the rest of the year is there. Next slide, please. Now, typically on this chart, those of you that have joined us before might notice that we're missing a negative axis on the y-axis, and because all subsectors, or all investment subsectors, or the overwhelming majority, I should say, have seen positive figures in their output and orders. There are some notable subsectors, and I suppose actually that the main subsector that hasn't followed the trend and is not forecast to follow a trend of strong recovery for the year is that of the aerospace industry. Now, the automotive and aerospace industry, arguably in terms of real output lost, suffered the most in 2020, with approximately a minus 23 to 25% decline in output. Now, the automotive sector is actually set to recover a lot of that lost ground in 2021, largely because that lost ground for the automotive sector was to do with material stoppages, material shortages that led to production stoppages, which led to sudden and violent declines in output. But for the aerospace sector, It's that demand in international travel and the international business community, and just a general suppression of commercial aircraft and commercial and logistical aircraft that's slowing that outlook now for the aerospace sector, which also leaves it as an outlier, which has actually looked to decline a little further in terms of total output in 2021, whereas most of the rest of the sector is posted for growth. Next slide, please. Now, where there is demand, it's good to see that the effects of the TCA, and I suppose we'll talk about this in a little more depth, is it hasn't been as suppressive in the medium term, or at least now in Q2, than perhaps it was feared in Q4 and at the very start of Q1, where we infamously had those ONS trade statistics in January saying that trade and exported goods was down by 40%, and it was quite a red flag for the moment. And that phenomenon has not continued. It has recovered quite quickly, but certainly not outpacing what historically trade with the EU has been. However, we see here that where there is new demand, Europe is still top of the table, and that is the status quo for what we typically see, given that the EU is our biggest trading partner for manufactured goods. North America trails second, and then Asian demand third, and this is a typical hierarchy, and it indicates that industrial demand across the planet is sort of at that not necessarily the levels, but the hierarchy is at the same pre-COVID hierarchies in terms of where that demand's coming from. Okay, so next slide, please. Now, this slide looks very, very similar to our first slide in terms of the bars, and it is the output and orders. However, each bar represents what manufacturers expected in that quarter. So when we talk about, I mentioned a few slides ago, we have that next 3 months bar. This is all of those lined up, and we've put this in with the dots now to show what the manufacturer's expectation was versus what actually happened in that quarter in our data. And so it's quite interesting to see here on the far right, if we look when the pandemic hit, there was mild positivity. If we sort of look around the 2020 Q2 mark, which is sort of 2/3 away on the right, we see it was quite a surprise, because the small amount of positivity expected, actually the pandemic hit industry incredibly hard, and we see those dots down there at that -52 area. And again, at Q3, we saw a sudden expectation. So the bars are very positive, and then the second wave hit, and then we saw less negativity, but still extreme negativity nonetheless. And then the inverse of that happened in Q4, 2020 Q4, where we see an expectation for a very, very bad performance within the manufacturing sector. But in fact, it wasn't nearly as bad as the industry thought. Perhaps it was now a little scared and a little once bitten, twice shy, given the expectation in Q3 that, oh, it's going to get better quite quickly, but actually the second wave hit. So then that pessimism trickled into Q4 expectations. Now in Q1, a tempered negativity, but actually opposed to positivity. And now in Q2, if we see moving along the right, tempered positivity and expectations, but what has actually happened is that the sector has outpaced its own expectations. And if that trends to continue, we have quite an impressive possibility on our hands here on Q3. Whereas if this is an underestimate from manufacturers, then we're going to be posting some quite high figures. And again, we might be, as I said at the very start, posting record-breaking figures 2 quarters in a row. But I suppose time will tell, and again, we'll see perhaps that positivity is ballooning too far, and we might not post actual figures as high as that, but we can say with a very high degree of confidence that we will be posting positive figures in the 3rd quarter of this year. Perhaps not to the extreme height that has been forecast by manufacturers themselves there. I'll move on to the next slide, please. Prices, and those I suppose now as COVID pressures and COVID issues, they all start to go on the back burner for 2 reasons really, because as the wider economy and manufacturers themselves start to get used to those processes and been working under those pressures for now over a year. An issue coming to the fore is the cost inflation and the input prices, which are not mutually exclusive from the COVID pandemic, of course, causing shortages, causing logistical backups, but also there's a lot of absolutely on the ground raw material shortages, and infamously that's been around for a while, is in semiconductor components, but also in certain plastics. Lots of our manufacturers struggling to get to some base specific plastics. Certain grades of steel, while they might be available, are seeing multi-factor price increases that make certain product lines unviable. And so it's quite a tumultuous market at the moment for, especially if your inputs are affected by some of these extreme inflations. At the moment, the data suggests that manufacturers aren't passing these costs onto their customers so much, and hence the hit that's being taken in margins. Margins are set to improve in the next 3 months somewhat. And however, the UK is in a more touchy position in a post-Brexit world with passing on those costs to customers, especially if those customers and partners are in the EU, because now there's the extra added paperwork and efforts around the TCA, but also now we really want to remain competitive in that market, and that's evident in the data with manufacturers not taking the hit on their margins before passing on to their customers for the time being. However, there is hope, and there is the expectation, and that's why I'm about to mention the next slide, that confidence is still there, because this is thought to be and still expected to be a relatively short-term phenomenon that we'll see throughout this year and perhaps into 2022. But there's certainly the expectation from manufacturers themselves that it will cool off and it won't be business threatening in the long run. And you can have the next slide, please. As I mentioned just now, confidence, and we've actually as well, if we look at 2 bars here, red bar, the top bar is business performance, so that's manufacturers, their confidence in their own business, and the orange bar below is that manufacturers' confidence in the wider UK economy. Now, we've actually only been recording this confidence in this form since 2014, but actually that red bar is posted its highest ever figure. But it's obviously not as monumental as the output that's been going on for 25 years. This is for about 5-6 years, but it's still interesting nonetheless. And it is reflective of a year of suppressed hopes and suppressed performance in the sector, and it can really see itself coming out the woods now. So it's not entirely surprising that we're seeing that extremely high confidence. And if we go on to the next slide, we see here that continues in employment and investment as well. And now there's 2 separate drivers behind these things. If we're going to start with investment, investment has been seriously hit, as you can see here, which is the orange bar throughout the pandemic. It's hard to now separate whether that investment spend is being stimulated by the super-deduction in the short term, and I think we're going to have some BDO colleagues talk to us in further depth about the super-deduction, or whether that is, and certainly some of it will be organic investment spend following that confidence, because we will typically see with a boom in confidence, boom in output, the boom in orders that I've just been talking about in earlier slides, it will be followed by investment. It will be great for the industry to see it sustained. And it does look that way in the short term. However, the real question is, once that super deduction drops off, will it remain positive? Because cash management and spare cash flow remains an issue for manufacturers as they restart production, and restarting production and getting back to business, so to say, is a very capital intensive procedure. Employment, which is the red bars, has jumped up, and expectations again next quarter for employment are very high. This is interesting because when the job retention scheme was announced many months ago, it was thought by analysts that it would be very hard to see a situation within the industry where the JRS is still active and to post growth in employment. But we're seeing that here with the JRS still just tailing off and just being active. We're still posting positive employment figures in the industry, and that's a sign of those manufacturers needing to fill, as we looked at earlier on, booming order books on aggregate, booming outputs, and needing that labor to deliver that work. And the next slide, please. This graph simply shows the combination of output and investment, and the point of this is to demonstrate that the data doesn't suggest that it's a bubble what we're going through, or something like a stockpiling blip, because that output, we're having that relatively extreme growth in output, and certainly within this chart in this time series, and we see that investment is trailing it. So it's just a good sign that this output recovery within the manufacturing sector in the UK is going to be sustainable, at least in the medium term, and it's certainly within to Q3 and Q4. And it's not a single quarter blip. And the next slide, please. And this is the penultimate slide, or the final slide really, and it's just to round off about that forecast that's been upgraded. Now in the middle here, our manufacturing output forecast is now up at 7.8%, which is very, very high. and especially seeing is that that's revised upwards from last quarter, where it stood at approximately 2.6%. In 2020, we can see both the UK economy and manufacturing output was suppressed by about -10% overall. In 2022, the forecasts remain somewhat unchanged. It's because that manufacturing recovery, it was forecast to come. What has really happened in the sort of the analyst side of things is that it's come a lot quicker than was expected. It was expected more in Q3 and Q4 this year to see the real pickup in industry, but instead it's come in Q1 and Q2. That wasn't really expected to happen, given that they thought there'll be more damning pressures following still amongst COVID, the effects of the new relationship with the EU being more suppressing, but the figures say otherwise in the short term. And the final slide, please, or I believe the next final slide. And this is very similar. This is the exact same slide as I first showed you. It's just 3 takeaways really to take away from this. That is the highest ever output we've posted on a quarterly basis, but contrast that with the fact that we're coming from a low base, and we actually posted our most negative and even more negative than the positivity we're experiencing now figures in Q2 last year. The second main takeaway is that despite all the difficulties with the TCA, the data would indicate that those are allaying somewhat, given that we're seeing already in the second quarter of the year, following negativity on exports in the first quarter, they're already picking up and we're seeing positive growth. So either those problems are being managed better or the problems are being allayed altogether. And then finally, is that expectations, forecasts, and Q3 and Q4, and particularly Q3, are looking particularly good for further growth, and I'll likely be here again next quarter. And I'd be surprised if I was coming with a negative story in the third quarter. So that about wraps it up for me and my section. Thank you for listening to that. I'll now hand you over to Steve Watts.
Hello, I'm Steve Watts. I'm a tax partner in BDO's Capital Allowances team. In the March budget, the Chancellor introduced the new super-deduction measures as the biggest tax cut in British history. These changes are intended to provide a significant boost to the UK's economic recovery, and the Office of Budget Responsibility estimated the measures would boost business investment by 10%, or approximately £20 billion a year. So significant changes, and in my session today I'm going to provide a brief overview of the new temporary first-year allowances and pick up on some of the practical considerations of the new rules. Next slide, please. So just starting with an overview and a recap on the changes that were announced and when they apply. It's important to note that the capital allowances changes are temporary, and the temporary first-year allowances, and they comprise the super deduction. So this is 130% first year allowance for expenditure incurred on main pool plant and machinery. So that's any expenditure that would normally qualify in the main pool at 18% writing down allowance basis. And in addition, the special rate, or the SR allowance, which provides a 50% first year allowance for expenditure that would qualify in the special rate pool plant and machinery. So this is in relation to certain integral features within a building. So for example, air conditioning, heating systems, electrical systems, etc. Also any long life assets, so any plant and machinery assets that have a life in excess of 25 years when new, and also the provision of thermal insulation to existing buildings. As I mentioned, these are temporary and apply to expenditure that's incurred in the period 1 April 2021 to 31 March 2023. And that ties in with when there's going to be an increase in the rate of corporation tax that will jump up from 19% to 25%. It's also worth noting that these allowances are in addition to the annual investment allowance, which was extended at the end of last year to provide up to £1 million of expenditure on plant and machinery to be offset up until 31 December 2021. Now, we don't know whether that will be extended further after the end of this year, or whether it will drop back down to the previous level of 200,000 per annum. So we wait to see what the announcement will be later in the year. unlike the annual investment allowance, the new temporary first-year allowances are uncapped, so there's no limit on the amount of expenditure that can qualify for the super deduction or SR allowance. Next slide, please. So just looking at some of the detail behind the super deductions. Firstly, it only applies to companies. So it's in relation to corporation taxpayers only. So any partnerships or unincorporated business or income taxpayers are not eligible for the super deductions and therefore would only be able to claim the normal rates of allowances available. One area to consider is that although it relates to expenditure incurred in the period 1 April 21 to 31 March 2023, it only applies in relation to contracts that were entered after the 3rd of March 2021, the budget date for the provision of that plant and machinery. So it's necessary to consider whether or not the assets will be within the rules. Now, it may be that, for example, if you had a construction of a new manufacturing facility, that may be made up of a number of different contracts that may have different dates. So it'd be necessary to consider which contracts for provision of plant machinery are within the rules and which are not, and therefore to claim allowances accordingly. The rules only apply to any expenditure on new and unused plant and machinery, so anything second-hand would not qualify, or the acquisition of an existing building which may include plant and machinery would therefore not be eligible. These are first-year allowances, so the general exclusions for first-year allowances do apply, and therefore, for example, any expenditure on cars or the provision of plant and machinery for leasing is specifically excluded. Now, the original rules, when they came out, also caught landlords, so property owners, who may be leasing plant and machinery alongside a property, were caught by the general leasing exclusions. There was a U-turn on this a few weeks ago now, when an announcement came out to say that actually any background plant and machinery, and background plant and machinery for these purposes specifically defined as a plant and machinery that's sort of forms part of the building to enable a building to function, will not be excluded where it's leased by a property owner to a tenant. In addition, hire purchase and similar contracts where assets acquired under these arrangements, the super deduction can be available. There are some additional hurdles to jump through in terms of the definitions of whether something is within the rules or not. And particularly, this is a specific requirement that ownership of the asset will actually pass under the agreement. With significant change like this, there are some fairly widely drawn anti-avoidance provisions to take into account, which gives fairly wide scope for HMRC to raise any inquiry investigations into manipulation of the rules. So any sort of contracts that are amended on uncommercial terms or cancelling contracts to get within the scheme may be looked at, and not very well. Next slide, please. Sorry, I'm not going to spend very long on this slide here, but this really just sort of demonstrates where the super deductions and special rate allowances feed in with the other various different types of capital allowances that are available and other reliefs. And as you can see, there are significant capital allowances, different forms and types of allowances that can be available and need to be considered to make sure that where expenditure is being incurred, the most beneficial and timely allowances are claimed at the appropriate time. Next slide, please. So as I said, there's a great deal of choice here in terms of the different allowances, and therefore it's important to perhaps model what will be the tax allowances available, and also in terms of what is getting the compliance position right for claiming the right allowance at the right time for expenditure. There is a bit of an interaction in terms of the annual investment allowance and the 50% special rate allowance. So it's necessary to look at what is the most beneficial treatment of utilising any annual investment allowance that's available, and maybe applying that before taking benefit of the special rate allowance to make sure you're getting the most accelerated allowance in the year of expenditure it's incurred. As I mentioned, the dates for contracts is necessary to consider, and this can be particularly complex where you have a number of different contracts making up the provision of plant and machinery and fixtures within the building. It's also important to note that any expenditure that does qualify for the super-deduction or SR allowance needs to be tracked separately. You don't claim this expenditure in the normal capital allowances pools. It's treated as a first-year allowance. It's claimed outside of the pools, and there is a need to track that expenditure because there is can be an adjustment on any future disposal of those assets, and I'll come on to talk about that in a bit more detail later on. One of the considerations may be where companies may have a sort of an overall, within their structure, a group property company and operating company structure. As I mentioned, the rules have changed now to allow group property companies to be able to claim allowances where they'd be leasing plant and machinery fixtures to other entities, but it's necessary to consider whether that expenditure is background plant and machinery or not, and making sure the expenditure is in the right company, whether it's in the property company or the operating company. Next slide, please. As I mentioned, leasing is specifically excluded, but it is necessary to consider whether leasing a hire is actually caught, whether you are providing services. If it's a provision of services as opposed to straightforward hire or leasing, then you can be within the super-deduction rules. As I mentioned, cars are excluded, but there may be other first-year allowances that can be available. For example, expenditure on low emission vehicles such as electrical propelled cars or very low emission cars can qualify for 100% first-year allowances. The normal disposal rules do apply, and therefore with any property sales there is still the opportunity to make elections on disposal of fixtures that have qualified for the super deductions. So this may enable to avoid a balancing charge on disposal of a property. As part of any tax due diligence for any corporate share acquisitions, it will be necessary to consider going forward whether a target company has historically claimed any of the super deductions, and that this is clearly identified and the information is available. And this is will be important because it will be necessary to identify any expenditure that has qualified on a future disposal. And just sort of picking up on the disposal points, if you could just move to the next slide, please, Pal. As I said earlier, any disposals will be a balancing charge as opposed to an adjustment to the normal pools. And there is also some factors that need to be considered if there is a disposal of any assets that have qualified for the super deduction in a relatively short period of time. So any disposals that take place in a chargeable period that commences before the 1st of April 2023, then it may be necessary to apply a what's known as a a factor to the disposal proceeds. So depending on the timing of the disposal, an adjustment will be required to the disposal proceeds. But after any chargeable periods ending after that date, then no adjustment will be required. Next slide, please. So just in summary, obviously that's just been a very quick run through the super deduction and just sort of picking up on some of the practical considerations that need to be made. Obviously, these are unprecedented and significant allowances that are available to encourage investment during this 2-year window. So it's important that any relevant expenditure is identified, and perhaps consideration of taking advantage of the opportunity to bring forward any expenditure plans to make sure the allowances can be claimed in that period. I'm now going to hand over to Lucy, who's going to talk about legal considerations for plant machinery contracts.
Thanks very much, Steve. I'm Lucy Pringle. I'm a legal director at Womble Dickinson, and I have a lot of experience of helping manufacturers with investing in plant and equipment. There's a number of reasons you might be looking at capital investment in the next few years, whether it's encouraged by the super deduction that we're discussing today, or as Verity mentioned, it might be driven by automation, digitalization, decarbonisation, or perhaps investment in your post-COVID recovery plans. So lots of reasons you might be putting your hands in your pocket over the next few years, and you want to make sure you're spending your money wisely. Unfortunately, capital projects do have a tendency to go wrong. So we really try to help manufacturers focus their minds on getting their CapEx contracts right from the outset, and that can help protect against problems further down the line. So turning to the next slide, please. Let's start by looking at some procurement tips for purchasing plant and equipment and avoiding unforeseen costs. So often the most difficult part of the procurement exercise for plant and equipment is getting quotations back from suppliers, which are on a completely different basis from each other, both in terms of what the price includes and the legal terms on which the equipment's offered for supply. So you need to make sure you're comparing apples with apples instead of apples with oranges. So you need to work out what you want to be included in the price and then draft your RFP accordingly. So then you can do a like-for-like comparison of the quotations you receive. Now that sounds really obvious, but often people focus on the price of the equipment or the plant, and they don't think about all of these things on screen. So here are some of the commercial factors you need to consider when you're scoping out what you're actually buying and what you're paying for. So does the price include delivery? Does it include the supplier coming onto your site, installing and testing the plant and equipment, and then commissioning it so it's ready for use? If the equipment incorporates software, then what's going to happen in respect to future software upgrades? Are they included in the price, or would you have to pay extra for those? What about servicing the equipment to keep it operational, both during the warranty period and over the full lifespan of the equipment? What is the warranty period? Are you getting 6 months, 12 months, 2 years, or do you get different warranty periods for different parts of the equipment? And also spare parts, those bits that might run out most quickly. Do you get some spare parts included in the price you're paying? So they're the sorts of factors that you want to think about right at the beginning at the RFP stage. Next slide, please. So then moving on to the legal aspects and how we can make sure we don't incur unforeseen costs or liability that you really haven't banked on. A supplier might give you a great price, might quote a great price for the equipment, but their terms and conditions are so one-sided that actually you have to walk away at quite a late stage in the negotiations, and you've really wasted a lot of time and effort at that point. So if you can seek agreement upfront on some of these sorts of issues, then you're going to save a lot of trouble down the line. Particularly if you can incorporate your own terms and conditions into the contract and include those in your RFP, then you're quite literally buying on your own terms, which is great. But your standard terms and conditions of purchase that you use as a business for buying, sort of widgets, biros, bulk materials, that kind of thing, are quite unlikely to be adequate for purchasing high-value specialist plant and equipment. So you need some terms which are tailored specifically for the purpose. And you will obviously have more luck securing your own terms in the contract if you put forward something which is reasonable, something reasonably even-handed between the parties. So, for example, if you include a realistic liability cap that the supplier is going to benefit from. If it's not realistic to impose your own terms into the contract, if the supplier insists on selling on their own contract terms, then at least set your expectations with the supplier at an early stage on these key legal aspects shown on screen, so that again, when you receive proposals from suppliers, they're easier to compare on a like-for-like basis. So have conversations up front about things like performance warranties, what will happen if the equipment is defective, whether you're going to be entitled to liquidated damages if the delivery of the equipment is delayed. Ask the supplier what sort of level of liability they would expect to have under the contract, and ask what their insurance looks like. And then in respect of overseas suppliers, and a lot of equipment does come from overseas, ask up front which law is going to govern the contract. Because if you can get all of those sorts of things agreed at the start of the process, then the negotiations will run much more smoothly. Next slide, please. So I mentioned before that your standard terms and conditions for purchasing are unlikely to be adequate for purchasing high-value specialist plant and equipment. That's particularly the case where you're having the kit installed or where you're having it put together with other bits of kit from different suppliers. And that obviously involves a much higher degree of risk, because if you're integrating different plant, then you need to think about the performance of the system as a whole and who's going to be liable if the whole system doesn't work. So here are some examples of the bespoke issues you might need to think about. Have you jointly designed the equipment with the supplier? Have you told them what your processes look like and then worked with them about what the equipment's going to do? If so, maybe it would be appropriate for you to have some rights of IP ownership. Think about whether the equipment's being procured as part of a bigger system, and if so, think about who has designed the overall system. Does the equipment you're buying have to interface at either the front end or the back end with other equipment? If so, who has designed the interface? Is it you, the supplier, or somebody else? And who is liable if the interface with the other equipment doesn't operate as intended? Moving on to software, usually industrial equipment, as I mentioned, will encompass software. So is there any element of that software which is bespoke to you, or is it off the shelf? If it belongs to a third party rather than the supplier you're buying the equipment from, then do you need a license of that directly from the third party? Is maintenance and support of the software included in the price? And if so, for how long? Make sure your contract describes the process for installing new updates and security releases. Next slide, please. You need to think about testing as well. Have you agreed that testing will take place off-site before the equipment's delivered to you, or will it take place on-site after installation? Who's going to be responsible for doing it? Is it you or the supplier, and how long will it take? Think about how the acceptance process is going to work. What constitutes takeover of the equipment? What happens if the equipment doesn't meet the promised performance levels? Do you get liquidated damages? Is there a baseline of performance, an absolute minimum standard it must meet, below which you can reject the equipment and get your money back? Moving to support, do you need the supplier to provide you with any training in relation to the use of the equipment? If so, make sure you agree the scope of that training, how many people you'll be able to have trained, where and when the training will take place, and whether the costs are included in the price. You might also need the equipment to be accompanied by a bank of spare parts, particularly those items that wear out most quickly. And then in relation to future support, the contract would normally require the supplier to remedy or replace the equipment or the relevant part if it becomes defective within the warranty period. But how many chances should the supplier get to try to fix the equipment before you have the right to send it back and get your money back? Think about what the expected lifespan of the equipment is. People tend to focus on what the warranty period is that they're being offered, but then they don't think about how they're going to keep the equipment operational in that gap between the warranty period and the expected lifespan of the equipment. So if the warranty period is only 2 years, but the expected lifespan is 20 years, then you need to think about how you're going to keep your equipment operational during that other 18-year period. So do you need the supplier to provide you with an annual repair and regular maintenance service, or reactive maintenance as well? Think about whether you can obtain servicing for the equipment from third parties, because if not, you can get held to ransom. Suppliers might offer you a very attractive price for the equipment, but then they know you're dependent upon them to do the repair work and the annual servicing because nobody else can do it. It's their proprietary equipment. And therefore, they really hike up the prices for that, and you end up paying them. That's where they made their margin. So that's something to watch out for. See if you can get them on the hook to provide those longer term preventative and reactive maintenance services at an agreed price. Same with spare parts. If you can't get a bank of spares, think about whether you can get spares from a third party, because if not, the same thing happens. Suppliers can hold you to ransom in respect of the cost of spare parts because they know you can't get them from anywhere else. So that's where they try to make their money. And a final point to consider, which isn't on the slide but is very important, is thinking about insolvency risk with respect to your suppliers. So you're probably going to be required to make advance payments if you're buying plant and equipment, and often that comes from overseas. But often people forget to take security over performance by the supplier. So that's a really important factor, particularly as we're expecting to see increased levels of insolvency over the next year. So that's a very quick rattle through some of the key legal pitfalls to look out for. And if you need any support with your asset purchasing arrangements, then obviously I'd be very happy to help. Back to you, Val.
Brilliant. Thank you, everyone. We've had a few questions that have come through. James, Verity, I'll pose the first questions to yourselves. So with the rising costs that we've seen over Q1, Q2 this year in regards to shipping, plus delays predicted to continue for the remainder of the year, how do you envisage the sector managing these disruptions and cost implications? So the person that's submitted the question has said that they've seen a shortfall in supply for electric equipment and components over the last few months.
I'll take that one. I would have to agree. In terms of that is the most prominent issue, I'd say, facing the sector now as COVID sort of becomes less of a concern, and the TCA, the novelty of the TCA seems to have been less damaging than initially perhaps thought. So now the limiting factor for the sector's recovery is those supply chain difficulties. We've heard, I'd say, the most major complaint we've had in terms of our membership, in terms of their performance of those manufacturers, is them being limited by shipping, by being able to get logistics, but critically people cancelling shipping orders because now they're too expensive and they're waiting it out. And their orders might be there, but they're having trouble fulfilling them for those cost pressure reasons. And in many instances, we've heard things as who asked the question, talking about the electronic supply components being extremely hard to get. We've heard from manufacturers them paying 30 times over the going rate for certain IC chips, making certain product lines unviable for the time being. But despite all this, and it's certainly been the limiting factor, we're still able to post those positive results. And as in my slides I showed, that those expectations, despite this very strong limiting factor in the supply chain, is still expecting growth in that output. So in terms of, to get around to answering the question of how will the industry cope with it, certainly in the course of the year, they're still able to deliver to us those better quarterly performances quarter on quarter, despite this challenge. And I think just anecdotally from speaking to manufacturers, there is certainly the sentiment that this will not become a systemic issue. that it might last, well, most likely going to last earliest into the end of this year, but it's certainly not going to be the new status quo. And that's at least the expectation and the sentiment that we're getting from our membership. So I hope that goes some way to answering your question.
There's a contractual aspect to consider as well. We're hearing the same from our manufacturing clients that shipping prices are absolutely exorbitant and capacity is really, really tight. So they're often struggling to make the delivery dates that they promised customers. And, there's obviously the additional costs and thinking about whether that additional cost has to be stomached by the business or whether it can be apportioned with the customer. So I think one of the key things to do is look at your contract terms and make sure that your delivery dates are estimates only rather than agreeing to fixed delivery dates, because if you can't get the shipping capacity you need, then it's really important that you can point to your terms and conditions and say, well, we didn't guarantee a fixed delivery date, because otherwise you'll be on the hook for a breach of contract claim. Also quite important to look at the increased costs and see whether your contract gives you any right to increase the cost. You obviously have to take the commercial decision about whether you would want to pass it on to your customer, but you need to look at your contract to see whether you'd be entitled to do that anyway. And that's both in terms of the increased shipping costs and the increased price of materials used to manufacture the goods. I think a lot of manufacturers might think that force majeure might grant them some protection. They might think, oh, well, this is force majeure because I can't get access to the, to shipping containers within the same time frames I normally would, and the prices have really gone up for raw materials. So surely that's force majeure. Surely that gives me some leniency in the contract. But the answer is it absolutely will not. Force majeure very, very rarely covers just increased pricing. So if you do think that you need to be able to flex your pricing because of increased shipping costs and increased raw material prices, then you really need to be thinking about putting hardship clauses into your contracts to give you the rights to do that and to avoid claims for breach of contract.
Thanks both, that's really good, helpful. So we've spoken about greater digital transformation within the sector. One of the questions that have come through is, can I claim the super deduction on the cost of acquiring computer software? So Steve, is that something you can help with?
Yeah, sure. Yes, software can qualify for plant and machinery allowances, and therefore, providing that the relevant conditions for the super deduction are met, then potentially would be eligible. But just to say, software by default is treated as for tax purposes as an intangible, and therefore falls within the intangible rules, and the tax the deduction would normally follow the accounting depreciation for deduction purposes. But it is possible where software is acquired to make an election to treat it outside the intangible rules and bring it into the capital allowances regime, and therefore claim the software as plant and machinery, and therefore, like I said, could be eligible for the super deduction if the conditions are met. So yeah, definitely.
Thank you, Steve. And Lucy, we've had one question coming through for you. So we are thinking about purchasing multiple pieces of equipment from different suppliers as part of an overall system. Should we get each supplier to install and commission their own equipment, or should we use our own contractor to do the installation of all the pieces of equipment?
It's a good question, because this crops up a lot. When you have multiple parties working on the same system, then if something goes wrong, everybody starts blaming each other. So if you've bought 3 different bits of kit from 3 different suppliers, and then you've integrated them and something goes wrong, then nobody accepts responsibility for the liability of their own kit. They say, well, it must be due to the interface with the other kit. So you can end up in a position where you can't claim against anybody. So you do have to be really careful where you're buying and integrating multiple pieces of kit. So I guess if you allow each supplier to install, test and commission their own equipment, then you've got much stronger rights against that particular supplier if their equipment doesn't function to the required standard. They can't shift the blame onto a central installer. on the flip side, if the equipment interfaces with other equipment, then it can be better to get a single installer to design the overall solution, including all of the interfaces between the equipment, and then get them to install everything. And if you do it that way, then there's a single point of responsibility for the operability of the overall system. So whichever route you go for, your contracts need to make it really clear what responsibility each party has for the design and interface and installation. Otherwise, that is a real potential pitfall.